Imagine for a moment a financial strategy so compelling, so accessible, that it promises to transform a modest monthly contribution into a substantial, six-figure investment portfolio. Does that sound like a fantasy? A pipe dream whispered by those selling unrealistic schemes? What if we told you it's not only possible, but has a solid foundation in the world of real estate, without the headaches of tenants, toilets, and leaky roofs? This isn't about magical thinking. It's about understanding and leveraging a powerful, yet often overlooked, investment vehicle. Welcome to a journey where we unlock the potential of real estate investment trusts, or REITs. Simply put, REITs are companies that own, operate, or finance income-producing real estate. Think of them as mutual funds for real estate. Instead of buying an entire apartment complex or a shopping mall yourself, you buy shares in a company that owns many of them. This allows you to invest in large-scale commercial properties, like office buildings, shopping centers, hotels, and even data centers, without the massive capital outlay or the day-to-day management responsibilities. You get a piece of the real estate pie, professionally managed, and traded just like stocks on major exchanges. Today, we're diving deep into what we call the 8% REIT Rule. This isn't a mystical incantation, but a strategic approach, consistently investing in REITs that yield around 8% annually, allowing the magic of compounding to work its wonders over time. The concept is elegantly simple, yet profoundly impactful. We're talking about a scenario where even a disciplined investment of just $500 every single month, channeled into these high-yielding, yet carefully selected REITs, can snowball into a truly impressive sum. Consider this initial scenario. You, the individual investor, commit to setting aside $500 each month. You then strategically allocate this sum into a diversified portfolio of REITs that collectively generate an average annual return of 8%. The beauty of this approach is that it democratizes real estate investing. You don't need millions to buy properties, nor do you need to deal with the complexities of property management, legal fees, or finding reliable tenants. This rule offers an accessible path to participate in the lucrative real estate market, potentially building significant wealth without the traditional barriers to entry. It's about empowering you to become a real estate owner in a manageable, liquid, and diversified way. The intrigue behind this growth isn't hidden in secret formulas or exclusive access. It lies in two fundamental pillars of intelligent investing: the relentless power of compounding and the strategic advantage of dividend reinvestment. Compounding is often called the eighth wonder of the world, and for good reason. It's the process where your earnings generate further earnings, creating an exponential growth curve. When you combine this with the consistent dividend payouts, characteristic of REITs, and then choose to reinvest those dividends, you're essentially putting your money to work, and then putting that money's earnings to work, and so on. It's a financial snowball gaining momentum as it rolls down a very long hill. Before we delve deeper into the mechanics and the fascinating history behind REITs, it's crucial to lay down a foundational understanding. This entire discussion is designed for educational exploration. We are here to illuminate a potential strategy, to explore its underlying principles, and to share insights into how it works. This is not and should not be construed as financial advice. The market is dynamic, and while historical performance can offer guidance, it never guarantees future returns. Investing always carries inherent risks, and it's vital to conduct your own due diligence or consult with a qualified financial advisor before making any investment decisions. Our goal is to equip you with knowledge, not to dictate your financial path. Before we continue, subscribe to the channel, and tell us in the comments where you are watching from. Now, let's peel back the layers and truly understand the engine driving this potential wealth creation, the REIT itself. The structure of a real estate investment trust is inherently designed to benefit shareholders, especially those seeking income. By law, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This isn't just a generous policy. It's a fundamental part of their legal status that allows them to avoid corporate income tax, provided they meet this distribution requirement. For you, the investor, this means a consistent stream of income, often higher than what you might find in many other asset classes. This strong dividend distribution is a cornerstone of the 8% REIT rule, providing the fuel for that powerful compounding effect we just touched upon. Beyond income, REITs offer a crucial element for any balanced portfolio: diversification. Real estate as an asset class often behaves differently from traditional stocks and bonds. Adding REITs to your investment mix can help smooth out overall portfolio volatility, providing a buffer against downturns in other market segments. It allows you to gain exposure to the real estate market without the concentrated risk of owning a single property. Furthermore, and this is a significant advantage over direct property ownership, REITs offer liquidity. Imagine needing to sell a physical building quickly. It's a lengthy, complex, and often expensive process. With REITs, you simply buy or sell shares on a major stock exchange, just like any other publicly traded company. This ease of transaction provides flexibility that traditional real estate simply cannot match. It's also important to recognize that not all REITs are created equal. The world of REITs is diverse, encompassing various sectors, each with its own characteristics and risk profiles. We have equity REITs, which own and operate income-producing real estate; mortgage REITs, which provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities; and specialized REITs, focusing on unique property types like data centers, timberlands, or even cell towers. Understanding these differences is key, as their yields and performance can vary significantly. An 8% yield in one sector might be sustainable, while in another, it could signal higher risk. Speaking of that 8% yield, it's a critical metric, but one that requires careful scrutiny. What does an 8% yield truly signify? Ideally, it represents a healthy balance between a company's earnings and its payouts, indicative of a stable business model and consistent cash flow. However, chasing yield blindly can be a dangerous game. An exceptionally high yield, say 12% or 15%, might be a red flag, suggesting that the market perceives significant risk, or that the company may be struggling to maintain its dividend in the future. It's vital to look beyond just the percentage and evaluate the sustainability of that yield through proper due diligence. We'll delve deeper into how to do that in the next part. But for now, remember that a sustainable 8% is far more valuable than an unsustainable 12%. Now let's return to the true magic behind the 8% REIT rule. Compounding. We mentioned the snowball effect, and it bears repeating because it is the single most powerful force. In long-term investing, compounding is essentially earning returns on your returns. When you reinvest the dividends from your REITs, those reinvested amounts then start earning their own returns, and so on. It's like planting a tree that not only grows taller, but also sprouts new saplings that then grow and sprout more saplings. The growth isn't linear, it's exponential. Time in this scenario becomes your most powerful ally. The longer you allow your investments to compound, the more dramatic the growth becomes. In the early years, the growth might seem modest, But as the principal and accumulated earnings grow, each subsequent return generates a larger absolute amount. Think of a small snowball at the top of a long, snowy hill. Initially, it grows slowly. But as it rolls further, picking up more snow, its size increases. And with greater size, it picks up snow even faster, accelerating its growth into a massive, unstoppable force. This is precisely how your portfolio can evolve over a decade or two, transforming that consistent $500 monthly investment into something truly substantial. Historically, REITs have demonstrated a compelling performance, often outperforming broader equity markets during certain periods. They provide a unique blend of capital appreciation potential and consistent income, anchored by tangible assets. Over the long term, real estate has proven to be a resilient asset class, evolving with economic cycles. However, it's crucial to acknowledge that REITs, like all investments, are subject to market cycles and fluctuations. They can be influenced by changes in interest rates, economic downturns, and shifts in specific real estate sectors. Understanding these historical trends and their cyclical nature helps manage expectations and reinforce the importance of a long-term perspective. This journey isn't about getting rich overnight. It's about disciplined, strategic growth over time. Now that we've established the foundation, let's explore how you, the viewer, can actually implement this 8% REIT rule. Finding suitable REITs requires more than just scanning for high yields. You need to delve into their financial health. Key metrics to consider include funds from operations per share, which is a crucial measure of a REIT's operating performance, much like earnings per share for traditional companies. Look for consistent FFO growth, indicating a healthy and expanding business. The debt-to-equity ratio is another vital indicator. A high ratio could signal financial instability, especially in a rising interest rate environment. Most importantly, scrutinize the dividend coverage ratio. This tells you if the REIT is generating enough FFO to comfortably cover its dividend payouts. A ratio below 1.0 means they might be paying out more than they earn, which is unsustainable. Due diligence is paramount. Never rely solely on the advertised yield. A deep dive into the company's management team, its portfolio quality, tenant base, and growth prospects is essential. Read their investor presentations and annual reports. Understand the specific markets they operate in. Are they in growing urban centers or declining rural areas? Are their properties modern and in demand, or outdated and struggling to attract tenants? Furthermore, even within the realm of REITs, diversification is key. Instead of putting all your eggs in one basket, consider spreading your investments across different REIT sectors. For instance, balance a retail REIT with an industrial REIT, or a healthcare REIT with a residential one. This strategy helps mitigate risks associated with specific market downturns or sector-specific challenges. Let's revisit the promise of a six-figure portfolio. With consistent monthly contributions of $500 and an 8% annual return, the power of compounding truly begins to shine. After 5 years, your portfolio could be approaching $37,000. Fast forward to 10 years, and you're looking at over $90,000. Push it to 15 years, and your portfolio could comfortably exceed $180,000. And by the 20-year mark, you could be staring at a portfolio well over $340,000, all from that consistent $500 monthly investment. These projections, however, come with crucial assumptions: a steady 8% annual return, which is not guaranteed, and consistent monthly contributions without withdrawals. The market is dynamic, and actual returns will vary. Nevertheless, These figures vividly illustrate the potential of long-term, disciplined investing. However, it's crucial to acknowledge the antagonist in this story. Financial complexity and market volatility. REITs are not without risks. One significant factor is their sensitivity to interest rates. When interest rates rise, the cost of borrowing for REITs increases, impacting their profitability. Higher rates also make fixed income investments, like bonds, more attractive, potentially drawing capital away from REITs and pushing their share prices down. Economic downturns also pose a threat. During recessions, businesses may scale back, leading to lower demand for commercial properties, increased vacancies, and reduced rental income for REITs. Property-specific risks are also ever present. A major tenant vacating a building, unexpected maintenance issues, or declining property values in a specific geographic area can all impact a REIT's performance. Finally, it's important to understand the tax implications. REIT dividends are typically taxed as ordinary income, not qualified dividends, which can mean a higher tax burden depending on your income bracket. It's always wise to consult a tax professional. To navigate these challenges, certain strategic considerations are vital. First and foremost, embrace a long-term mindset. This strategy is for investors looking to build wealth over decades, not for short-term gains. Market fluctuations are inevitable, and attempting to time the market is often a losing proposition. Secondly, employ dollar-cost averaging. By investing a fixed amount, like your $500, every month, you automatically buy more shares when prices are low and fewer when prices are high. This strategy smooths out your average purchase price over time and reduces the impact of market volatility. Lastly, periodically rebalance your portfolio. As your investments grow, some assets may outperform others, skewing your desired allocation. Rebalancing ensures your portfolio remains aligned with your risk tolerance and financial goals, perhaps by selling some of your best-performing assets to reinvest in those that have lagged. The journey to a six-figure portfolio, or even beyond, through the 8% REIT Rule, is not a fantasy. It's an attainable goal for the diligent and patient investor. Consistent, disciplined investing in high-quality REITs, coupled with the magic of compounding, can be a tremendously powerful tool for wealth creation. You, the viewer, are now equipped with a deeper understanding of this potential path. But remember, this is merely a starting point. We strongly encourage you to conduct your own meticulous research, explore the diverse world of REITs further, and consider consulting with a qualified financial advisor to tailor a strategy that aligns perfectly with your individual financial situation and aspirations. Share your thoughts and experiences with REIT investing in the comments below. Your journey to financial empowerment begins with knowledge and consistent action.